Hey everyone, welcome to the Your Money Your Life podcast episode. We are on episode, I don't even sure. I think we're on episode 256 of the podcast. And guess what? We're the last podcast of the year for 2024. We're wrapping up this year with a bang. So before we get into it, make sure you like, subscribe, 5-star rate, and review this pod wherever you are listening because you do this every week and you want to share this with other people so they can do this every week. Let's get right into it. We're going to dive into a market update and really just talk about what is how the market is closing out the year um, for 2024. And in the roundtable, we're going to look back at this year and look ahead to 2025 and tell a little bit more about what I think going into the year and also how I thought this year went and our predictions in the beginning of the year. I have them. So if look at it, Thursday, the market's about flat. There's not much crazy movement trading. It's supposed to be the Santa Claus rally, which occurs in the last 5 trading days of the year, usually, and the first two in January since 1950. If you look at that Santa Claus rally period, since 1950, the S&P 500 has generated an average return of 1.3% during that period. Again, that's that last 5 trading days of the year into the first two in January. During this period, widely outpacing the market's average 7-day return of 0.3%, that according to LPL research. So you usually see a little bit of a bump towards the end of the year. Again, that's historically speaking. But right now, again, let's look at our chart. The last 5 days are, actually hitting at 1.61%, 1.61%, excuse me. So roughly in that range. If we stayed this way into the first days of January, we'd be roughly in that Santa Claus rally range. Year to date, again, we're going to talk about the market this year, but another strong period. Even that blip we had on that day where the market moved viciously down, we almost recovered some of those, if not most of those losses here in the last week or so. So another showing of how strong the market's been this year. And we're going to talk and look back at what it's happened this year. But let's get into news. Admittedly, this is going to be probably a lighter news week. There wasn't much going on. You had football, you had basketball, you had people hanging out with family. But you did see that Netflix released Squid Games too. I love Squid Games, the first one. Trying to get my wife into the show. She doesn't really want to like the show. I don't know why. It's like a contrarian thing. I don't know. But I like the show. I'm gonna watch it. But Netflix went all in on this, and they're saying that Netflix. I'm sure they invested a lot of money into the second Squid Games, and they're saying it's supposed to be huge. I'm trying to see what exactly is okay. So they use football. They use marketing genius steps. They did football stunts to pink burgers to Duolingo. They use different things to market the second Squid Game. So if you weren't aware, maybe you just haven't turned on Netflix for a little bit. But they're pretty much saying that they put a lot into it. They unleashed a game as well in collaboration with this new season. So they have a lot of different things coming on. Pretty much saying you have to be aware of it, and they put a lot into it. They also had the first live football games, live NFL games on Netflix yesterday on Christmas Day. You had two good games. Then you had a performance of Beyonce at halftime of the second game. So Netflix is doing a lot of different things. We've been a proponent and a bullish advocate of Netflix for a long time, and you're seeing some of the trends we talked about live sports. If they did live sports, that would be huge. All these different things are so important, and Netflix seems to be making those moves. This is an interesting story. They're saying low cost airlines are lifting small cities. So, two new airlines are looking to take advantage of underserved markets at smaller US airports. This is per the New York Times. Avelo Airlines and Breeze Airlines, they both launched in 2021. That's actually crazy. You never really hear of airline launching. It's cost so much mixed capital, it's cost so much money to launch an airline. But these airlines are looking to take advantage of these low cost routes between cities that have largely been ignored by the major carriers and characters. The additional flights are helping boost businesses at Tweed, New Haven airports in Connecticut, for one, which now has a schedule of about 30 departures per day, up from just a few daily flights 5 years ago. Interesting. Interesting. So these new airlines are really going after that low cost mid-tier areas and trying to lift traffic in those areas. So that's actually a really, really interesting point and story there. I want to watch out for these. And I guess what did it cost to launch these airlines, Avelo and Breeze? I'm actually curious what it cost to launch them. You don't hear much about airline launches, but they're saying that Avella will fly more than 250,000 customers. And they're looking to really, ever since taking flight in 2021, they said they couldn't be more optimistic. This is the chief operating officer, the LinkedIn post. So that's good. It's a smart move, right? Like there's not that it's going to be good. Going to be meet a market demand that isn't being met. So it's a smart move. If you ask me, I think I'm actually curious to see how that goes. Let's take a look about the VC world, venture capital. Quick refresher. If you don't remember, venture capital, they have funds of pooled money, usually of high net worth individuals or usually people that are comfortable taking on certain risk because they have more liquidity. They then take that money, invest it into startups of all kinds at all stages, depending on their strategy, and then hopefully return a profit when that said startup it grows and sells to someone bigger, maybe goes public, private equity firm, any of those sorts. So they're saying that venture capital firms are seeing higher partner turnover either because high performers are moving to new firms or they're starting their own, or because those with underperforming investments are being weeded out amid an industry downturn. So there's an industry downturn. Remember when everyone wanted to be a VC and invest back in the day? It was like 2, 3 years ago. Now they're saying a lot of those people that are investing or raising funds weren't really investing in smart things and or their performance of the funds isn't going well. So there's a downturn in the industry. There's a lot less liquidity, a lot less people wanting to invest during these times, and you're seeing senior roles that have historically been held for decades at these VC firms, the partner roles, are now being turned over. They're attracting. They're now being turned over. It said in 2024, only 9 firms raised half the capital allocated to venture funds, while all emerging funds combined brought in just 14%. Interesting. So emerging funds is a new emerging fund manager, not an established name. Interestingly enough, you're seeing the VC turnover. So I'm curious on what is driving this. It's going on over seismic. So if you're seeing, this person's saying in 2025, you're going to see more bespoke independent firms catering to niche markets. You're also going to see greater appetite for alternative investments like secondaries or off-market assets. And so they're saying that a lot of departures in VC and tech right now, and partners in tech VC, I should say. It makes this person think about the industry shift in a different way. A lot of capital is poured into areas like fintech and blockchain in the last few years, which made it easier for partners to spin off and start their own funds. Interesting. So you have a mix of people starting their own funds, which I'm always a proponent of someone going on their own and being successful. Or you have a mix of underperformers being weeded out and people realizing that the fun, easy times of just everyone investing is over. And it's now the people that are had a solid plan still around doing so. So it's interesting enough. Got to keep our eyes on that. Got to keep our eyes on that. Anything else? This was an interesting story about malls. Boom, bust back from the dead. Why are mall retailers the most interesting stocks in the market? So, the number of malls open in the U.S. is dipping, right? Like that number is small, is getting smaller. And you see people write about that, but they are saying that the retailers within the malls are actually having a decent enough time. Are people going back? Are kids just interested in the stocks themselves? But that's an interesting story to keep your eyes on. But if you look at this chart for the YouTubers, the number of malls has the last decade has steadily decreased as people are going to shift to the online model. Kids, Gen Z buys a lot online, and malls aren't as prevalent as they were when we were kids, right? Even for me, I wasn't a mall person. I was a basketball after school person, not a mall hanger outer. Did I miss anything? I don't know. We don't know. Let's dive into our roundup of the week, which again, we're going to go over in detail our last year's thoughts that we had last year. Pretty much what we stated last year was pretty much what happened in the sense of I pretty much said that we would see, another gain on the year for stocks for equities. I said it wouldn't be as great as it was in 2023, which we beat 2023. I'm actually curious, did this year beat 2023 in terms, and we're not finished with the year yet, but I'm curious if we did in terms of return. So let's take a look. I'm looking at my other screen for the YouTubers to double check how we did. But in any event, we really pretty much said that we're going to see another good year of good returns, and really that investors should stay invested because that is, our thing is we also thought there would be a broadening of investments. So I got the data last year. We were actually ended at 24% on the S&P 500. So far this year, the market is showing 26% on the S&P 500. So we did better than last year in 2023, which is what I didn't expect, but I did expect us to be green. I said that there'll be a broadening of investments, meaning not just tech leading the way, but also other industries coming into the fray, and then other industries performing well. It was heavily, again, tech outshine. The win in the NASDAQ is up over 30% in the year, which again, we're heavily invested in tech. So that's a good thing for us and for our clients, over 450 households, which we just really, really have been growing as all normal, as well as assets that we manage growing. The agency started. But if you think about, again, last year, we thought that there would be broadening. There was a little bit, but we also thought that we'd be have a solid year, which we did. So if you look at forward to 2025, I think, the base case, we're going to see 5, 6 months of investor optimism into 2025. So in the first quarter, quarter and a half, I think we'll have a strong, the market will still have a strong performance. Maybe see a correction in the middle percent part of 2025. That's the base case, right? That's what I'd see. I think we end the year green, not terribly green like we've seen the last couple of years, but maybe just slightly green, I believe. Bull case, something material happens. Maybe we have a massive quantitative easing, which again is not our base case, but if it does happen, you'll see lower rates. You'll see mania and bullish mania that we saw in 2021, investors gambling, all that stuff could potentially come back in 2025 in the bull case, the crazy mania case. In the bear case, any spikes that we see in unemployment data, any spikes we see in inflation data will force the Fed's hand in one way or another, which will, if you see the unemployment data spike, that's signaling a recession. If you see inflation data spike, you're signaling the Fed being more hawkish, meaning that they won't lower rates as fast, meaning that we'll probably be in a situation where stocks will have to take another pause. So that's the bear case, right? And so our base case, I think you see a little bit more optimism into the new year. People think there's going to be deregulation and different things of that nature that's going to have a push and momentum for stocks going forward into the new year for the first half. And then there'll be a pause. I still think for us, we liked our winners. That was winners in 2024. Crypto, which again, we said hold those assets, which I personally have, and told people, every one of those people, to hold those assets because that's what long-term investors do. And that had an incredible increase this year. The numbers should speak for themselves when it comes to cryptocurrency. Close to 100,000 now. It did break over 100,000. I still believe it would be higher throughout the end of the year into January. Tech stocks, they're not going away. You just have to hold them. You don't need to try to trade and do different things. We've just been holding good stocks. And we also like small cap right now. Small cap underperformed 2024, but I think with this bullish run, we'll see small caps might have a little run. And so we like those areas in 2025. Again, I think we see ourselves a little green this year and potentially not as bullish his last couple of years. But that's what I'm seeing for 2025 and on. We're looking. I probably put out a newsletter for all of our subscribers for this to see it. But again, we've had a joyous 2024. Hope everyone had fun time with their family on Christmas and will have a safe New Year's and holiday. Again, we're doing this more in 2025. We're gonna have more things to share about the cool stuff we're doing, but we'll save that for another pod. Thank you for joining, and we'll talk soon.